So we are going to do a past paper question of June 2015, paper 41. But before we go to that past paper question, we need to understand two things. First thing is, what is the difference between a fixed capital method and fluctuating capital method? So what is the difference between a fixed capital method and fluctuating capital method? So whenever I have a statement of financial position, and in my statement of financial position, when I have been given on the liability side, capital account and current account both. So on the liability side, if I have been given capital account and current account both, it means the method of accounting that I am following is the fixed capital method. The fixed capital method tells me that the capital account of my partners. So if I have partners and I have the capital account, so the capital account of the partners will change only and only because of the following things. So the fixed capital method tells me that whatever is the opening balance of the capital, the same shall remain the closing balance of the capital. The capital balances should not change. So that is why they are calling it as a fixed capital method. But the capital will change only because of the following things. If I am bringing in a new partner in my firm, so the capital will change because of the additional capital which the new partner may bring in cash, or the new partner may bring assets as additional capital. So when I am following fixed capital method, the capital account balances may change because of additional capital, number one. It may change because of revaluation. If you have any revaluation profit or you have any revaluation losses, it can change because of that. And the third thing, it will change because of goodwill raised. You should always know that goodwill is raised among the old partners, old ratio, and goodwill is written off. Goodwill is written off among the new partners in the new ratio, or I could say it is written off amongst all the remaining partners in the remaining profit sharing ratio. So when I follow fixed capital account method, the capital balances will change because of additional capital, revaluation, profit or loss, and the third thing, because of goodwill adjustments, that is goodwill raised and written off. So what will happen in the current account of the partners? So when I follow a fixed capital method, accounting method, I will prepare two accounts related to the partners. One would be the capital account of the partners. One would be the current account of the partners. The capital account will incorporate all things related to capital introduced or capital withdrawn. Number one. The second thing that would happen in the capital account is revaluation profit or losses will be distributed amongst the old partners in the old ratio. Third thing that would happen is you will raise goodwill and write off goodwill. So capital account balances will only change because of revaluation, goodwill, capital introduced, or capital withdrawn. Now what happens in the current account? Okay, the current account, they will have the opening balances and everything else related to the partners would happen in the current account. That is, I could say my interest on capital will come in the current account. The drawings would come in the current account. Where will the drawings come? On the debit side. The drawings would come in the current account. The interest on drawings would come on the current account. Interest on loan would come in the current account. Okay. Uh, then the closing balance will come in the current account. So all these things would come in the current account. So a fixed capital method and a fluctuating capital method ensure that two separate accounts of partners are maintained for capital. But when I have a fluctuating capital method, everything is kept in the same account. Okay. Now the next thing that you need to understand is how do I calculate NATO? I am talking about NATO. NATO means net assets taken over. So the second thing is how do I calculate NATO, or I would say how do I calculate the net assets taken over. So NATO is calculated by assets taken over, assets taken over. So I will take over all the assets, whether it is a non-current asset or whether it is a current asset, all the assets taken over minus all the liabilities taken over. So all assets taken over minus all liabilities taken over will give me my NATO, or I could say it will give me my net assets taken over. Now you should understand that the net assets taken over is nothing but your capital. So all assets minus all liabilities would give you your net assets taken over. Sometimes my question tells me, okay, they will give me my net assets taken over at the end of the year. Okay, and they will give me my NATO, the net assets taken over at the beginning of the year. They will give me my net assets at the beginning of the year, and they will give me my net assets taken over at the end of the year. And they will ask you to calculate profit. In such a situation, how will you calculate profit? So in such a situation, you would prepare a capital account. Okay, the net assets taken over at the beginning. Okay, opening net assets would come on the credit side. Closing net assets would come on the debit side. Where will drawings come? Drawings will come on the debit side, and what you will get as a balancing figure would be your profit. So we say closing net assets plus drawings. What we say? We say CCD minus O, opening. So we say closing net assets plus your drawings minus your opening net assets, closing net assets plus drawings minus your opening net assets. If whatever answer you get, if this answer is positive, that means you have a profit. And if this answer is negative, that means you have a loss. So sometimes they will ask you to calculate net assets taking over. Then they will ask you to calculate profits. How do you calculate the net assets taken over? Your total assets taken over minus your liabilities taken over will give you your net assets taken over. Now in the next video, we will do some related to preparing partners capital account, preparing partners current account, and calculation of net assets taken over and profits. It is a question of May-June 2015, paper 41.